So just to kind of recap on the market cycle, typically I'll spend a couple of minutes on this slide or next slide, because what happens, the market cycle and deal making and how you structure a deal, that goes, they kind of go hand in hand, and one pushes the other one, which way you structure it. So let me give you the context, then I'll get into the report, and then I'll get into the retail. So you have a macro view and the micro view as well. So as some of you guys know, 21, then at 22, here we are at in 22. Reflection is everybody, most of the folks who made deals in 22 and coming into 23, even though during the up cycle, you should take less loans. Like when the market is at the peak or going up to the peak, your portfolio should not have too much of a loan pending. So you should have less of a loan going into those markets. So typical conventional is if you do a fixed debt, it's low risk. If you do a non-recourse bridge with a no interest rate cap with the pref equity, that's the highest risk. Good chunk of the syndicators, they kind of did that, right? They went this way. Massive side, we have only one asset we won in that way. So we got the tail end of it, but after we caught a wing that market's going to change, we flipped the whole coin. Everything is on an actual basis, no pro forma, things like that. So the finance first is a big deal for us. But in the market, it went the other way around. So when 23 came and 24 came, it was problematic for a lot of people because debt has to be paid, money has to be earned, but the money earned went away, right? So that's the background. In 21, 21 going into 22, during that time, we should have, we saw the money's coming in from the Feds, money's gonna go to the system, more money, more buying power, more competition, hence inflation, then do less debt. That was the model. So that's what happened. Now, when we're at the bottom cycle, it flips. It should be this way, right? Where you want to take loans. So oftentimes we have seen this year and last year, a lot of folks are doing loan assumption at a 2%, at a 3%, at a 4%. And for us, we didn't do it because our assumption was it is going to be higher for longer. We'll say a version of it. Then inflation is sticky. They don't go away right away. And 3 years is not a whole lot of a time. And so if you get anything at a 3-4% or 2-3-4%, which you have to sell in 3 years out at a 6-7-8%, then you have to work quite a bit for free just to kind of catch up on the valuation. So the goal is when the market downturn happens, you take as much loan as you can. That's the fundamental philosophy, which is a little bit different than what you'll be thinking about it because you're scared, right? But this is the time you rack up as much loan as you can, you lever it up as much as you can, as much as possible. So when the market gets better, your portfolio gets even better with it because you kind of designed it that way, right? So our goal has been this year all the way. We like bridge debts. We like a full recourse loan. We like new construction because you're exposed to a lot of things. As the market gets better, then you'll be getting better alongside with it, right? So as timing, we don't know, but we're taking the macro side. And most of the big shops, you'll see that's what they have done. They had their pencils down here, and all the news that you heard, the big boys have put the pencils down. That's the reason. And all the transaction that you see beyond the news, beyond the negative news, where big guys are buying $100 million deals, $200 million deals, $300 million deal, is because of that. And they're buying those at a loan assumption at a very high rate. Maybe they're having the lender stay in, so all of a sudden your leverage is high. So that's where those sophisticated transactions are happening. So if you take that and then go to the next slide, so what's going to happen in 25, right? 24 we're out, and 25 it's right around here somewhere. So last year it went too fast, too quick. We're trying to figure out what happened. This year, going in, we understood what's going to happen, so we have to kind of prep for it, plan for it. Now next year we kind of sort of see it. So if I have to draw a line, I would say, hey, whoever has whatever portfolio, if they can make it till Q3 of next year, then it is highly likely that that team will make it through all the way. All right, so how that plays to the that. So this is The ENY report, if you go Google 2025 economic forecast, ENY, well, I talked about it a little bit. So they do a big forecast. I like the ENY. I like the Deloitte. Goldman Sachs is kind of crazy, and none of the other teams are as good as these three consulting groups, right? So this is the economic forecast. The very bottom, you could see the US. It's about 25, 1.2. Some would say 2.5, some would say 1.1. Whole idea is that we're not going to grow as much as we have grown this year. I'll talk you through why we think that's the case, and then we'll do some debate about it if you I know if you have time. So 1.1, so it's still the economy is going to grow, and not all the sectors will grow. So that's one of the positive signs. On the other side, I believe the number was we have to grow at a 5% or 4% to be a net surplus. Right now we have a deficit, but to get over it, we have to grow at that rate. And you'll see how we're gonna play with it, some of the levers that we have and how we deploy that. But all in all, it's flat to the growth, still a good sign. And if we look at the median across the globe, it's 2.2. And India have the highest trajectory. Mainland China, it's a false number anyways. They used to go at a 6 or 7. Right now they're, I don't know, two-thirds of that. So that's all. And whatever happens to us, Mexico and Canada will kind of follow through as that happens. So all in all, this is the data. So the rate cut was a boost. And again, having said that, one single rate cut is not going to work. Having even multiple rate cuts, it's not going to get to a point. Everything will come through from the floodgate. So another way, 25 will be a version of 24, but with a lot more optimism in it as you kind of kick in. Let's look at even a broader view. I really like this chart. This is across all the central banks for the major countries. At bottom, I kind of highlighted that. South Africa got a rate cut. Sweden got a rate cut. Turkey, it's in a worse spot. The UK and US, Switzerland, everybody taking a rate cut, right? And South Korea, whatever happened last couple of weeks, crazy anyway. So, but the European nations are cutting it. We're going to cut it, so more rate cuts to come, right? So again, going back, 25 will be a slower than historical level. We got the geopolitics to be coming to an end, which is a good sign. And the recession has been mostly avoided, but there is a case we're seeing the recession. So we'll talk about the slide, the next to that one. So a version of recession, the risk still exists. That risk that we have on the recession, it's from the government angle. As you know, the GDP, a good chunk, 1/3 of GDP is growing by the government spend. And when we go cut down the government spend in a near term, you're going to go deeper into a recession, then you're going to come back up. What's the likelihood? I don't know. We haven't quite. The Dodge version is coming up. As that thing matures, we'll see where we at. And we could see the both tug of war. And one side, we're saying we're going to cut the jobs and we're kind of gearing up. I think those two will do a good job. On the other side, Biden administration is passing rules where hundreds of thousands of people have approval to work from home for the next 4 or 5 years. So it's a balance. All right, going back, those are some of the greatest risks of profitability. Within the North America, you can see the interest rate. So everybody's agreed on that one. It is higher for longer, and that is the highest risk. The number 2 is the cost of capital. So debt's available, but at a higher cost, and equity costs going up. If you stack together, price has to come down, right? Something has to happen, right? So that's a pretty beautiful way to kind of take a look at it. The cost of capital is high. How that's going to go down, we don't know, but then we'll kind of go from there. European nation has a different issue, not us, right? So their interest rate are different score than us, but from the US perspective, it's the cost of debt and the cost of capital. Both of them are the highest risk as you kind of get into it. And so to going back a couple of things, as I kind of talked about, it was really interesting when I saw this about a month ago. 80 countries globally will be holding election in the next 12 months. That's a lot of dynamic change as you kind of go through, and then especially the 15% global minimum tax, and that's going to come into play hopefully. So if you can follow the Twitter for President Trump and some of the other, the Ron Paul, and that's the one he was after. That why U.S. money is going outside the U.S. for tax evasion. Why don't you flip the coin, make us a Dubai, the money will come here, better for us, right? So that's there. So macro perspective, again, markets come into steady state, cost of debt and capital will be the biggest thing to go. One of the interesting part is that's not in our control, so we cannot do anything about it. And we should not have emotional feeling about it. Well, we just have to say, if I plug in those numbers, what the return looks like, what the price looks like, and you can make an offer, right? It gets interesting from that sense. Slide after is that in which sector will grow the most. And that's the idea. So we are positioning our portfolio that side as well. Number one, multifamily. That sector took the fair share of bidding last 2 years. It has normalized, and there's one more optimization will happen. Price discovery will happen. That is going to happen, this year. I mean, next year as we kind of go through. One of the things happened, what we call it, the properties with the longest loan assumption, they had the premium. They're able to get some profit out of it. Those have been sold. Those Class A sophisticated sellers who knew they're not going to make any money, it's easier to get the keys back. They did them already. All the folks who kick the can till next year and then keep on adding the money. At some point, they're going to run out of money and project has to be optimized. And that phase is going to happen now till next year throughout the whole process. So the servicing company and the lender, that's how they're positioning themselves as you kind of go, because they kind of got out the worst timing and are getting into 25. So that sector will get the biggest push because the loss on the other side is gain. Second one is the logistical and warehouse. It's a pro business. We're gonna see a lot more business coming in, and a lot more business will give you a lot more push in the service center warehousing. It's there. So from massive side, we do multifamily, we do industrial warehouses. We have 4 in the pipeline now. So we are placing our bets accordingly which way the market's gonna go. Then hotel, it's downside. We don't do that. Residential, it's an upside. We don't do that. We do BTR, but the projects are pretty holding. We're holding that tight, not focusing on it. If you go down to here, the retail center, it's a steady state. So for us, we're adding a non-volatile asset into the mix of the portfolio. And that's one thing that we're doing. We are targeting the neighborhood retail centers that follows those houses. So we are not in the house and on the residential, but we are following the residential wave, but getting something steady state. So that's how we are looking at it. So we're in multifamily, we're in a business part logistics, we have industrial space, and we have neighborhood retail. So you're building a holistic portfolio, and that's how we kind of go from the massive side. That's how we're taking a look at it. We are looking at 25 and trying to plan accordingly. All right, let's look at the last one. Now, this is the another slide. Okay, sorry. Okay, this is the better slide. So what is the forecasted rate cut for next year? We've been following this matrix for last 24 months now, and they have came about right almost all the time. One of the misses we didn't take a snapshot as when, but if you take a look at it, we have a meeting coming up in about a week. We're expecting a rate cut. So either way, we have a rate cut coming in, but no back-to-back. Between those two, looks like we're going to stay in that 425, 450 range, right? One drop from there. And then you can see the Q1 one coming up. And then you can see the Q2 one coming up. One of the things that we kind of aligned, the Fed's going to hold the rate at a 4%. If they can get it, it's a win for them. And we're expecting we'll be there at the end of the next year. And that's why you see everybody saying, I'm going to stop, assuming at a 4%, that's where I'm going to stay at. So from now till next year, this time, we're expecting at least a 1% cut, if not a little bit more, but 4.25, that's where Feds are working to drive everything. So going back, inflation is sticky, pro-business government, that means that money into the economy, that means more purchasing power, that means more competition, that means more inflation. To offset that, finding a government job, that means lower GDP, that means slower economy. Then we have a short-term dip that and offsets the purchasing power. Hence, it's a balancing act. So that's what we're looking at. So yes, 25 will be interesting. That's really good, and we have to just continue to invest as you go through. All right, so that's been the setup. So why we believe that the retails are a good spot. So let me walk you through how we take a look at it. What's the difference between a mall and a retail strip mall? And then I will give you the the current definition of mall or current look feel of a mall, because typically mall, as we all grew up in the mall, it's like go to Katie Mills Mall, right? One big thing, walk around. That concept's still there, but it's not as dominant and the outlet mall that we thought of a decade ago. So the outlet malls are becoming the today's malls, which is a version of the street malls as that happens. All right, so concept. So sorry about the typo. So here in this particular case, the street center, so typically in a street center or in urban areas, and if you get an acre, 2 acres, you're good to go. It has easy access, public transportation, you can walk. The stores are wide range, right? From medical and a dentist, next to an ice cream, next to a nail salon, it kind of goes. It's open air, but it supports a neighborhood. It supports something. It's not a destination, right? The operating hours typically is not, I mean, widely, but it's typically 9 to 9, or 10 to 9. Foot traffic, dynamics, management, independent store management, and it's a social integration. Versus the mall that we see, it's the destination, usually in the suburb or outskirt, because inner cities already feel, full. It's tough to get 2 acres in the Heights area to build a new retail center versus you can find 20 acres in Katy, right? Again, it's often reliant on private vehicles that you got to drive. That's chain and franchise. It's controlled. It's the whole thing. It's about the aggregation. If you go there once, you can go to a couple other places, then you can come home. Versus here, just one and none, right? So let me show you some examples. This is the new version of mall. It's not the old version. So this is a live example of Ellison Retail Center in Ellison, Katy. You can see the Target here on my bottom right, again Parkway in the top right, the whole thing. You take the Ellison, and this is Target on the other side. Realty One is working. So there's a family office from Houston. They invested $27 million to buy this land, this tract and this tract. They're building phase one. If you drive by there, you'll see all the buildings coming up. So it's not enclosed anymore. It is open air, outlet mall type design. And where you go, and you can go to one place, you can get your taco, have your burgers, go walk around, go to wherever you want to go. If you buy a property, go do closing, then you come home, right? An example of the retail strip center, which is you take one of the buildings and you make it nice, or one of the buildings, spin that a little bit, that's your retail center. So different between this and that, if you do it right, if you take one building, that's your retail center. If you put all the buildings and create an environment, that's your outlet mall, that's your retail center, destination. This is the Candela Shopping Center. Just wanted to share some of the projects that we are working on and how we are designing it, so you'll kind of see that way. All right. So second question is, how do you pick how do you pick a location, right? Sorry about that. Let me see. I don't want to do the typo. Location probably. It's going to bother me. Thank you. All right. So we have about 5, 6, 7 factors, and I'll show you about 5 of them. Depending on the retail, you ask a question, it's the location and the accessibility, which is how far you're going to drive. Look at the demographic and the target audience, and the competition market saturation. Number 4 is the proximity. Number 5 is the cost analysis. So here, location. As of now, majority of the new constructions are for Class A value-based pricing. So it has to be next to something. And the next to something is very important, whatever the next twos are. If you go to suburbia, then it's next to some brand new houses coming up, right? So that's there. And the demographics and target audience, again, it's if you go inner city, you are driving, that I'm stopping by to pick up my velvet taco, right? I'm doing my drive-through. If you're doing a suburb, then it's a stay-home mom, working couple in the evening, less, drive time. They have to do what they have to do for their kids, right? Right next to my house, they have a small retail center coming in, small 25, 30,000 square footage of, and there is a pizza shop. We know the owner of the pizza shop, they cost about 20, 30% more. than any other chains, but we go because we like to go hang out. We like to go talk. My kid can take his bike and he can go, and that's the target audience that you are providing a satisfactory emotional satisfaction on top of the pricing, and that's where we do most of the value-based pricing. The competition and the market saturation, we call it, there are three things: Gen 1, Gen 2, and Gen 3. Generation 1 is you are the first dentist, right? Or you built an office for the first dental dentistry in that location, which is typically a target, right? By targeting at a location, right? The big box and the smaller ones go to the big box. Gen 2, you are the second one. Gen 3 is typically there was a land left over. We're trying to do something with it. That's there. We don't do Gen 3. We try not to do Gen 1. We do Gen 1-ish and a 2. That we're the first follower, not the first mover. We're the first follower. So we try to be end of the Gen 1, early Gen 2 to create the competition as you go. And the proximity for the supply logistics, again, whoever needs whatever, then we kind of go. If that's a warehouse, flex space, we look at the freeways, we look at the thoroughfares, we look at the traffic, then we decide. And a 4-lane is always better than a 2-lane, and then a freeway is always better than the 4-lane. And what side of the street are you in also drives a lot of competition. Sometimes you'll see one side of the freeway doesn't work, but on the other side of the freeway, for whatever reason, it's just fantastic, right? And we kind of do some analysis there. Last thing is the cost analysis. If you think about it, cost of construction in Houston, Austin, San Antonio, DFW area, within plus minus 10, 15%. Now, land price will vary, but the rent is more or less the same, right? So if the rent is the same, construction cost is the same, then the only thing is left is only two things are left, which is the ease of getting permit and cost of land. So we always look at that, and that's the value chain. Like, what's the amount you can spend to buy the land? How long does it take? And then cost of construction and the rental amount, then around the value chain. I'll give you an example. If it's San Antonio, you can get in and out less than 9 months with the permit. If it's Montgomery County, 6 months. Harris County, 9 to 12 months. If you go Austin, I wish you the best. If you go Dallas area, I would say year and a half, you'll be in and out. So understanding those, they have a dynamics, how it plays it to the price. And we kind of take a look at it, and then we decide how to pull the lever as we go. Okay, so this is the one I kind of talked about a little bit briefly. Location and accessibility for retail, for new construction, location. I cannot say anything about it. It really matters, right? Land could be free. You can build something on it. But if you don't have the right location, you're not going to get the tenant. And that's going to be the problem. And again, understanding the customers are very important, extremely important. If you go build a retail center with entry-level homes where that median income or the household price is $200,000 for per average house, that type of tenant you're going to get for your retail center will be different than if you build a retail center next to a neighborhood where you have $300,000, $400,000 worth of homes. Now, the dynamics are when you design those areas, you have to pay a different type of land price, and you can design certainly differently as you kind of go through. So again, it's just knowing the market. You can design your product, even though you could stand out, but to make sure cost-wise you're efficient. Competition, market saturation, we talked about it. Now here, the proximity to housing. Efficiency is key to profitability. Nobody wants to drive, number one. And if you drive no less than 2, 3, 4 minutes, and especially if you drive in today's day, if you can't find parking, you're not gonna like it. Yeah. So that's very important to understand how far you are at, and you kind of go. And the cost, the bottom line matters. Balancing the construction costs on the site and land costs is very important. So going back, one of the things that we're seeing, on the slide I talked about, that we have a high debt, we have a high cost of equity, and then that means expected return, it needs to be high. Keeping those three things, one thing that wasn't in the play is coming into the play is the tariff. The tariff is coming. It's not going away. By the time tariff shows up in Q1, your lumber cost from Canada, your metal cost from China is going up. How much is going to go up? It's yet to tell, but we are assuming it's 15 to 20%. So if the construction cost 15 to 20%, that's going to put a back end pressure on the land price. And so understanding that dynamic and that you invest in the right way, it really matters. So what we're doing now to reduce the cost of capital, at least the work it takes to raise the capital on top of the cost of capital, and also to protect the price of the land and not discounting it heavily because we pay for the other things. One of the business model that we are working on this year, that we worked on this year and next year moving forward, is the joint venture with the landowners. So instead of them getting a transaction, you sell, I buy. What we're providing with the seller is like, hey, take a percentage of the capital, but roll the rest of the capital as a JV partner with us, and you stay into the deal. So not only you get to sell the property at a higher price, on our side, we don't have to raise. So cost of capital going back to the seller. Number two, your taxable income is very low compared to the whole thing. So you save some of the taxes. Number three, the money that you had, you have to go somewhere. So you don't have to worry about that reinvestment because your dollar is staying in for 3 years with us. So you're not only making more money, 3 times 15, 45, 100, almost 150% more with your net earning, plus you're striking a higher price, plus you're not paying the tax today. It becomes a long-term gain as you go through. Putting all together, we're doing JV quite a bit. We have 3 JV conversations in the pipeline. We have 1 property under contract that is on JV. It's a 506B. Can't talk about it, but I mean, I'm not raising money, by the way. It's a $5.5 million total equity needed. Seller is staying in at a $3 million. We are buying the property at a $4 million. So she's taking $1 million out. She's staying in $3 million. We'll call in 4, 5, 6 people, raise $1.5 million, $1 million, and it's done. So that's the way we are designing wherever possible, which is also why one of the reasons we are bringing on Emily, because we need to talk to everybody. Everybody wants to talk. So we can understand what is it that you're looking for, what is it that you want, so we can find projects that suit your investment requirement as you go. So, and this is the Candela's return. As I was mentioning, it has your portfolio. It's a 3 years hold time, $50,000, 21 to 22% IRR. So you're quick in and a quick out as you go. High velocity return. So going back where we started, as an investor, you always got to make a choice, right? We create value when you make a choice, right? If you don't know how to make a choice, still make a choice. I'm not doing it, but let's be clear in your mind that, hey, I'm going to do it. I'm not going to do it, or I'm not going to. For me to do it, XYZ has to be true. Let me go investigate, get grounded, and get ready, right? So on this note, we are finishing up. This is the horizon one. We are finishing up that one. We don't have much left. And then the high velocity as you go. This is the last year of 60% depreciation. So it's going away. Hopefully, I don't know, but we got 20 days.